understanding capital gains tax is something really important to maximize the power of your investments. So when we invest, there are three different types of taxes that kind of arise from investing. The first one is capital gains tax, the next one is dividend tax, and the last one is interest income tax. Now let's start with them in reverse order. Interest income tax is when you have, for example, a money market account, you own bonds, if you have an income fund, any of those things. When you earn interest on your money, you will pay tax in terms of your income tax. So interest income falls under the category of income tax. However, what's different about it is that each year the government gives us a certain little amount of free interest income, which is why it's also important to maximize that, to make sure that you're at least getting all of the free interest income that you are allowed or claiming it, and also that you're maximizing that interest income. Now, dividend tax is what happens when a company makes some money in a year, they make a profit, and the way they get that profit to their shareholders is by declaring a dividend. So they say, okay, we've made $1 million in profit. We are going to give every single person who owns a share 10 Rand. And then that 10 comes into your tax return, but as a separate line. Dividend tax is always taxed separately and lower than income tax. And then capital gains tax. Now that's the thing that we're going to talk about today. So let's say that you buy an investment, any investment for 100 Rand. We call that 100 Rand capital. It's money that you have put in to start your investment. And then what happens is that your capital grows by 40. And when it grows by 40, that is a gain on your capital, or shortened to a capital gain. And in total, at the end of the year, you have 140. Then the next year comes, and you then earn more money. It grows by 60. That capital gain is added to the total of 140, and now your investment will show a balance of 200. So here's the thing. That 200 is in fact made up of 100 of the capital that you put in, or half of it, 50%, is 100 that the capital you put in, and the other 100 is made up of the gains that you earned through the years. And what happens is that that difference is recorded every time in terms of the reporting of a share or an investment, in the fact that they know how much you put in originally, and then they see what the balance is now. So that 200 is made up of half of capital and half of capital gain. So over, let's say, a number of years, 5 years, what happens is that as your investments grow, each of these little capital gains accumulates. So in this particular example, at the end of 5 years, there was 400 in capital gains. So I want you to think a little bit about capital gains like the house you own. If you buy your house for 500,000, and right now the agent comes around and she evaluates it and she knows the area and she says it's now worth 750, then in actual fact 500 is the capital that you put into the house and 250,000 is the gain. So your 750 is made up basically of those two portions. 2/3 is capital and 1/3 is the capital gain. Now 3 years later you sell your house, and by that stage it's worth $1 million. It is only when you sell your investment that you, what we call, realize the capital gain, in that the capital gain is just a theory until you actually sell that investment. Someone buys it from you, and when you sell it for $1 million, your purchase price, or the capital that you put in, was 500,000 and the gain was 500,000. And that's what happens with shares and investments, is that until you actually sell the investment, it's just kind of a notional amount. Remember, they always teach you in economics, willing buyer, willing seller. If someone's prepared to pay that amount of money for your house, then that's what your house is really worth. But here's the challenge. If you start investing at 20 and you retire at 65, over time, that gain can be a very large portion of your total amount. So in this example, we have R1 million of capital and R2 million of capital gain. So 1/3 is capital and 2/3 is capital gain. And then what happens is that you decide that you want to retire and you want to start using that money. And so you withdraw 300,000 Rand in the year. Now that's a bit like, in inverted commas, selling a little piece of your house. So now you realize that capital gain. And so it is recorded that of that 300,000 Rand, 1/3 or 100,000 Rand is capital and 2/3 or 200,000 is gain. And what happens at this point is that you get taxed because you finally sold. That capital gains tax over time can start to amount to quite a bit of money. But capital gains tax in most countries and in South Africa is actually always less than income tax, which is why we choose to use capital, because it drops the tax rate that you pay. Now, here's an important tip, and this is kind of really what the whole thing is about, is that every year we get given 40,000 Rand of free capital gain. So let's go back to our beginning example, that you buy an investment for 100 Rand and it grows over the year by 40, so that your investment is now 140. Now, this is the really important thing, is that we have the ability to sell investments. So unlike a house, when you can't sell a window or a door or a tiny piece of your house, you can sell investments, shares and funds and things like that. So if you sell at the end of the year and you say to the tax man, listen, I'm declaring the 40, which is a gain. He'll say, that's cool, you've got 40,000 free in gain, so that 40 is fine, we'll just give it to you for free. And what actually happens is that you then turn around and you buy back that exact same share if you want, or so your circumstances on the market have changed, a different share, but you buy it back at 140, that exact same amount of money. Because next year, when it grows by 60, now 140 is capital and only 60 is a gain. And then you repeat the process. You say, hey, Mr. Taxman, I'm selling, so I want to tell you that I've got a 60 gain. And the taxman says, that's cool, you've got 40,000 in free gains, that's perfect. And then in the next year, that full 200 is capital. So what that allows us to do over the years is to reduce the capital gain that you're going to experience when you eventually use it. Now, obviously, for some people, 40,000 is a tiny amount of money in what they earn, but every little bit helps, and it also makes us just that little bit more conscious of optimizing our tax over time. Now, when you sell that investment and you rebuy it, there is going to be a few days between obviously selling the investments and then rebuying. So there is a slight risk that the market might move in those few days. But in general, unless it is one of those unbelievably rare moments of time, like for example the 2008 crash and the COVID crash, which were a couple of days, it is absolutely, in my mind, worth the risk. So sell it and replace it with a very similar share, or trade it for something that is within your strategy, and then you minimize that risk. Now, it's also important to know what it doesn't apply to. Tax-free investments or savings, it doesn't apply to those because they are tax-free. So the great beauty of a tax-free investment is that it doesn't have any form of tax applied to it. No dividend tax, no capital gains tax, no interest income. So what happens is that you allow all of the growth in a tax-free investment gets applied to you. a retirement annuity and a living annuity work the same way. So obviously a retirement annuity you have before you retire, and a living annuity you have after you retire. And what happens with these is that you don't pay tax on the capital gain each year, no matter how much you buy and sell or trade. But what does happen is that when you retire, you pay income tax. So on all of the money, even the stuff that's capital. So instead of paying 18% capital gains tax, you will pay, could be up to 45% income tax on that same growth. So it's really important to understand that you don't pay capital gains within a retirement annuity and a living annuity. So by selling or changing the shares that are within those portfolios, you can't use that against your free capital gains allowance. And then lastly, endowments. Some people have endowments, particularly overseas, and an endowment is actually owned by the life insurance company. It's not owned by you as a person. You are what's called the beneficial owner, so it's yours to enjoy. But from a tax perspective, it's owned by the life insurance company. And so endowments have flat specific rates on interest that's earned. That's 30%. So if you're a 45% tax owner, that taxpayer, that's why it's good to have an endowment. But their capital gains tax is 12% flat. So if you are a 45% tax earner again, you would benefit by not paying 18% capital gains, but only paying 12%. So that's why people use endowments. We use them offshore because they are very good vehicles in case you pass away, and make sure that you don't have to worry about probate in any foreign countries. But onshore, we use them for high tax rate payers because you pay less capital gains tax, less interest income in those vehicles. So a quick note on tax-free investments, just to kind of add or make this a holistic presentation, is that you're allowed 36,000 Rand a year of a contribution to a tax-free investment. So it'll effectively take you 15 years to reach the government maximum of 500,000 Rand in total. But because it is limited to that 500,000 Rand in total, you always want to use it or think about it as retirement money. So in order to have the real benefits of it, you don't want to use it as a savings account. You want to use it as an investment vehicle over a long period of time, because it will save you all that capital gains, and also it will save you all that interest income. Now, here's the thing though. If you use it as a savings account and you put 100,000 in and you withdraw that 100,000 in out, you will only have 400,000 left. So you're only allowed to deposit once in an entire lifetime into a tax-free investment. So that's why it's not a good thing to use a tax-free investment as a savings account, because you reduce the amount of money that you can invest over the long term and you don't get the full benefits. If you're saving for a goal and you're going to earn some savings interest and take it away and then put some money back in and then take it away and then put some money back in, it's better to use a normal savings account or money market account. And what we want is that long-term savings or investments for retirement, because that grows tax-free. And then to close off the thing on tax seasons and things like that, is that each year all of us have 100,000 Rand that we can donate to another human being free of tax. Now, transfers between husbands and wives are always tax-free. So you can transfer shares out of a husband's name into a wife's name tax-free. You can transfer money tax-free. They're always tax-free between a husband and wife. But to anybody else, if you want to give money to your children, if you want to give money to anybody else, a trust, anything, you need to donate it. And when you donate it, you will pay 20% tax on that money. So it's really important that if you do have a plan to donate to a trust or a fund for your grandchildren or anything like that, that you use your 100,000 of free donations tax each year. So that ends this little series on the tax year end and things that we can optimize. Take care and let me know if you have any questions.